G'day everybody, Max right here, and I'm very happy to have one of our favorite guests to have on the show, Juan Villaverde. Juan, thanks so much for joining us.
Max, good to see you again.
Awesome, buddy. Well, listen, we always have so much fun talking about macro, talking about crypto, talking about all the fun things. Listen, something that you talked about going back, I think, a couple of episodes ago, you talked about how as we drive into winter, the situation in Europe is going to get really, really bad. You're over there in Europe. I wanted to check in with you. How is it over there? Like a year in Spain, I guess, down the southern parts of Europe. But what's going on in Europe? Is this energy crisis show any signs of easing? And is Europe in for a very tough time this winter?
So there's multiple answers to that question. Just as an anecdote, I just had my electricity bill came due. We pay it every couple of months here in Spain. It came due earlier this month, and my God, I was like, I'm not going to say what the number was, but it's insane. I'm pretty sure that a lot of households are hurting right now because I'm doing okay in terms of my income, so I can afford it. But it was crazy. So that's just a personal anecdote. So prices are surging. Electricity and gas prices are surging because Europe doesn't have they don't have energy sovereignty. They used to get it all from Russia. Now they're getting it in the form of LNG, which is the second thing that I wanted to address. Is I've been hearing a lot. I don't know if I said this in this podcast, but in my view has always been Europe is going to have the energy. It's just a matter of what price are they going to have to pay, right? Mm-hmm. So they have the energy. So there's not going to be a crisis. People are not going to freeze to death. It looks like, because also we're having a super warm autumn. I'm still wearing my T-shirt. And it's November. So this is crazy. Now, Spain is a pretty warm country, but not this warm, not this time of the year. And I hear the same thing from the friends that I talk to in Germany, in Norway. It's the same everywhere. So we're experiencing a much milder climate than some people fear. So the worst case scenario has been avoided. We're not going to run out of energy in Europe. However, the price is going to be astronomical. And governments are already on the case. They are doing all manner of subsidies. I think the latest country to announce a subsidy was France. France is going to subsidize about I think they announced like $100 billion euro package to subsidize their soaring energy bills. I'm not hearing anything from Spain because actually most of the gas that is coming in the form of liquefied natural gas, LNG, a lot of it comes through Spain. So Spain doesn't have the same problems that others have. I think I saw recently that headline like CPI for the Eurozone is at about 10%. We're at 7.4, 7.5 here in Spain. So it's a little lower. The crisis is not as severe. I always thought, if you're going to be somewhere in Europe this winter, it should be a warmer country like Spain that did not rely on Russia at all. Spain again, somebody can fact check me here, but my understanding is Spain never used Russian gas. Now, it doesn't really matter because it gets distributed, right? But it was never that big of an issue. However, my prediction was the energy is going to be there because this is Europe. And I want to get into that because I do want to address something that a lot of people are saying. And so we'll get into that. But the energy is here. It's just super expensive. So what are governments doing about it? We're subsidizing it. They're spending money to combat inflation, which is the only thing that they know how to do, really. When inflation goes up, they just print more money. And really, and this is what I want to discuss, because I think there's a lot of people were saying, especially the doomsayers were saying, Europe cannot print energy. No, but they can print euros and use them to buy energy. And guess what? A lot of people will sell them energy for those euros. The euro-US dollar market is the most liquid pair in the world. So Europe can still swap as many euros as they want for dollars and pay for their energy needs. It's going to be poorer countries that may freeze this winter. It's going to be the likes of Pakistan that may not have the resources to pay for the energy, because Europe knows that it is competing with Asia, especially for energy. And guess what? They're outbidding them right now. So would you rather sell to Europe or would you rather sell to a poorer nation? Probably Europe. So Europe is pricing out poorer nations, just like the dollar now, and the Fed are exporting inflation across the entire globe. They're not the ones who are suffering the cost of a higher dollar. It's poor countries. It's other places in the world. So you're seeing the same in Europe now as they hog these energy resources so to keep themselves warm. And I guess myself as well, living here. I'm not from here though, so I have a different view on that. It's pretty much what I thought it was. I have to say that I've been thinking a lot about this issue lately in terms of who's going to pay for all this? Like, who's going to pay for all these subsidies? Is it going to be the ECB? My view is yes. There's another possibility though. And this is something that's happened it was announced by Janet Yellen. I don't know, people are talking about this in my opinion. The date that I've seen is that starting on January 1st of next year, the US Treasury is going to start buying their own bonds. They're called them buybacks. So they're going to be the ones buying their own bonds. They're going to be the ones doing QE, quote unquote. In the same way that Europe now is printing money, but through the banking system by they are instructing commercial banks to extend credit to, like, for example, failing energy companies or companies that may have margin calls because their energy companies that short all this, they sold all this energy forward, so they have this massive margin calls. And so the state is directing banks to extend credit to them. In my view, and this has not hit the mainstream yet, but in my view, this is just money printing. It's just another form of money printing. It's not the central bank this time. It's commercial banks directed by the government. And I think we're going to see a lot more of that going forward, because it was this week or last week, they had this like green swan conference from all these central bankers. They're talking about climate change and how they're going to fight climate change through finance. I mean, I didn't know there was a connection between the weather and finance, but apparently the European luminaries think there is. And you know what this is? This comes down to, we're going to tell banks to lend to companies and groups that are favored politically. So whatever they think should get money will get money. And they're going to use laws and regulations to do this. They're not necessarily going to use the central bank. It's just going to be, they're going to tell banks, hey, you need to lend money to this guy, not this person. This company that produces, windmills, yes. Energy, oil explorers, no. Drillers, no. Fracking, hell no. But if you want to do a solar panel, sure, we'll give you some money. And this is money printing too. They're just directing credit in a different way. This is what's coming. I mean, so I kind of see it as, and it's no coincidence that as all these things happen, Janet Yellen saying, hey, we're going to be buying our bonds. We can get into that if you want. Or all these Europeans they keep doing subsidies. The craziest thing to me is the UK. They have this new prime minister. He looks nice. He wears a suit. He talks slowly and with confidence, because that's what they're trying to do. They're trying to restore confidence. They had a crisis of confidence, really. That's why people dumped their bonds. What most people seem to forget is that about 2/3 of Liz Truss's budget was energy subsidies. These are still in the budget. It was only about 1/3 of the money she wanted to spend that was tax cuts. I mean, God forbid she should dare do stimulus into a depression, but she got fired for that or lost her job. So the new guy comes in, they're still doing the subsidies. So explain to me how any of these governments are actually reining in their spending. And the answer is they're not. And so there's two culprits for the inflation we're seeing now. One is the central banks that enable governments to borrow and spend like it's going out of fashion. Governments are still borrowing and spending. They're not slowing down. In fact, they're not going to slow down at all. All I've seen is they're going to continue to do this. So there's two possibilities, really. Either the central bank will cooperate, they'll find someone else to do it. And it could be commercial banks. It could be that you and our money, the money that is sitting on financial institutions, that money is used to bail out the governments. It could be that. That's a worst case scenario, you ask me. And it's far worse than the central bank printing, because this is actually our assets are locked up in government IOUs, government paper. It could happen. Either way, unless you see governments willing to lower their spending and balance their budgets, which is not going to happen, then inflation is here to stay. Inflation hedges, or really just assets that are outside money, what Zoltan Posner called outside money, money that is outside the system, these things are going to do well. And I can't think of no better asset than crypto, Bitcoin specifically. It's outside the system. That's what you want. Because by hook or by crook, they're going to print money. And they're either going to use our money or the central bank is going to devalue. That's really what we're facing here.
Do you think so? By the way, for our viewers at home, and if you've seen one in other videos, I should mention that we've talked about his timing model. So make sure you stay to the end of this video. We're going to talk about whether or not his timing model has flipped bullish and in the long term and short term. So make sure you do that. So back to your point, Juan, do you think we are arriving near a time where Bitcoin stops trading as a risk asset and starts trading as an inflation hedge?
That's an excellent question. I'm not sure. The reason I'm not so sure is because we're still stuck with this Fed pivot narrative. And I swear to God, I have Fed fatigue at this point. I mean, I've heard enough about the pivot and whether or not it's going to happen. I don't think it matters. I don't see it as trading as a risk asset. Just to give you an example, today is November 4th. The non-farm payrolls number, it wasn't it was like the unemployment report came out in the US, and apparently unemployment ticked up. It went from like 3.4 to 3.7%, something like that. And risk assets are partying. Why are they partying? Because the Fed pivot is near. So we're still stuck in that paradigm of everything's just following whatever they think the Fed is going to do. So do I think Bitcoin's behaving as a safe haven or risk-off asset? Not yet, because I don't think it's hit the majority of people yet that what we're facing is a sovereign debt crisis. That's really what we're facing here. These Western nations are on the brink of default. So you want something that's out of the system because they either print or default. Either way, and listen, if they default, you lose your money. You lose everything. So you want something that you can have in direct custody. That's Bitcoin. If they inflate, they're going to devalue the currency. You want something in direct custody. That's Bitcoin.
The only question for me is the timing issue, right? So you got these two arguments trying to weigh up against each other. One argument is there's going to be a crisis. We know they're going to print. When they print, some point people will figure out gold, silver, crypto is your way to hedge against this kind of actual proper inflation, right? You've got this other argument. People have such little savings. They're so poor. You can't eat gold, silver, and crypto. They might have to spend all their money on heating, food, and whatever, such that they can't afford that. They have to liquidate gold, silver, and crypto in order to put food on the table, gas in the furnace. So there's this timing issue. Well, which one goes first? What are your thoughts on that?
So my thoughts on that have not really changed. I've always been of the view that we're going to see inflation. And if you see inflation, you're going to have, this is the thing that the Fed, for example, and central bankers fear the most is that wages go up as inflation goes up, because it's a self-reinforcing cycle. So there's a positive feedback loop between rising wages and rising inflation. It makes sense. I mean, if you pay people more, they go out and spend more. So that makes people, supply of assets doesn't necessarily go up. So then prices go up, then people demand higher wages, and on it goes. That's what we saw in the 70s. We saw it across the world, by the way. That's their fear. Now, in that kind of scenario, I would argue that the decline, I don't want to call it collapse, the decline is very slow. It takes place over many years. I think that's what we're going to see. And since I think that's what we're going to see, I do believe that there's going to be plenty of time to exit and people will have enough money in their pocket. The other thing I would say is there's always a pool of capital somewhere. So someone is always holding assets. You're not going to have a situation where everybody loses across the board. I mean, a lot of wealth will be evaporated if governments go into default, but some wealth will be left. That money is going to exit the bond market. Bond market is the biggest in the world. It's going to go into real assets. To be perfectly honest with you, I think most people will buy stocks because they're not really inside the government. They're large corporations. You could think of them as real assets. But a lot of money is going to go into gold. Less money is going to go into crypto, but crypto is a smaller market. So the one asset that will go up the most is going to be crypto. And for you and I and people listening here who we're just individuals, the crypto market is big enough to park a big chunk of our wealth there to benefit when governments go default. Now, again, to me, default looks like inflation. I don't think you're going to see nominal default, so-called nominal default. In other words, they don't pay their bonds. That leads down the same rabbit hole. And by the way, one thing that Jay Powell said this week is they're not really that worried about inflation or something breaking in the system because they can fix it. That means money printing. He basically told you, listen, if something breaks, we're going to print again. Don't worry about that. Stop worrying about, the end of the world of deflation. We're not letting that happen. He just told us that. Yeah. That was a great answer. And it's very honest too. If the Fed breaks something, and I think they will, probably the bond market, they're going to print. He just told us that. So
yeah, I mean, it's always the plan. I mean, he's trying very hard to break the stock market, I think. Make people feel poor. That'll solve his inflation problem. They'll be too poor to bid up the prices of things, so they just won't go without. And then he solved his inflation problem. I think the race against time is, does the repo market and the government markets, the things they care about, break first, or does mom and dad get poor first? Which one declares insolvency first, mom and dad or the government?
So I think I have the answer for that in this context, and this is something I don't think anybody could have known going into 2022. The bond market is pretty broken already, and the stock market is only down 20%. Crypto has probably made a bottom. We'll talk about that later. So I'm not seeing the bloodshed and risk assets that I myself and many others feared, and yet the bond market is almost at the brink of collapse. This cannot continue. The bond market need someone to throw them a bone. That's why that's why Janet Yellen is going to buy her own bonds come January, because they know they have a big problem. To be honest, the way I see it, they saw what happened in the UK. They know they're all swimming naked. The UK is not an isolated example. I believe I said this many times. This will happen elsewhere unless they do something. And so look at the sequence of events. This idea of the Treasury buybacks from the US Treasury by Janet Yellen was floated earlier this year. They kind of stopped talking about it. Then UK pension thing happened. Now they're talking about it again. Now we have a tentative date. Just to explain what I mean by Treasury buybacks, when the Fed printed money last year, about $2 trillion of that money just sat at the Fed. The Fed was worried about inflation last year, even though people say they weren't. I wrote about this, and I think the first time I wrote about this was July 2021. I said the Fed worries about inflation. Here's why. They are paying banks to park money with them. So they're paying banks not to take money out into the real economy, and instead they're incentivizing banks to deposit money with them. That money doesn't exist, not really. It exists only as digits in the Fed's balance sheet in a computer somewhere. So they were sucking money out of the economy last year. Now there's about $2+ trillion sitting in there, and Janet Yellen knows that. So what she plans on doing is incentivizing banks to take that money out and give it to the Treasury. How are they going to do that? They're going to issue very short-term debt because there's a lot of demand for that. I don't want to get into the specifics for why that is. Frankly, I'm not even quite sure myself. There's just a lot of demand for short-term government paper. I believe it's because it can be used in a repo market, so you can lever it up. If I have short-term bills, I can borrow dollars against that and buy even more short-term bills, so I can lever up that interest rate. So for technical reasons, there's a ton of demand for short-term government debt, not a lot of demand for the long-term stuff. So what they're going to do is they're going to force banks, not really force them, incentivize them. Again, for now, we're just in the incentives phase, the carrot phase. There's no stick yet. They're going to incentivize banks to buy all this government debt, and then they're going to use that money, about $2 trillion, to buy the bonds nobody wants. Why do they want to do this? Because that almost broke the UK and forced the central bank to pivot in October. So they worry about this. They know this is coming. So to answer your question, what breaks first? Is it the repo Treasury market, the bond market, or the average Joe on the street? It may happen simultaneously, but I'm pretty confident now that the bond market is about to break and nothing's done. So this happens within the next 6 months, I would say, if nothing is done. But again, they are doing something. So the Treasury buyback is QE, in my view. And I believe the market kind of sees it that way, because just the minute they started floating this idea, I saw risk assets go up, and a lot of people who are in the know, who know a lot more about this than I do, they were saying this amounts to QE. I mean, they're taking money that's in the Fed and they're going to use it to buy bonds. That's QE. That's what it is.
My
market breaks first, in my view.
The bond market breaks first. My high level thought about this, and remember my investing strategy is 70% conspiracy, 30% technicals. Is I'm like, okay, if the government's the one with the guns, will they sacrifice the citizen for themselves, and do they have the guns to enforce it? And my answer is yes to both of those. It's like that. It's like, okay, yeah, fine. The bond market's going to break first. Like, okay, well, here's what we're going to do. No problem. We've got a solution. Everybody, we're sending around the police force to steal everything out of your home. Oh, we've got a solution. You're all going to internment camps. You're going to work for free. Don't worry, we'll give you food. Like, there's nothing they won't do. Desperate governments do desperate things, and there is nothing they won't do. So it's like, well, how do you win? Like it's like they want everything to go broke. They want you to be broke. They want all the companies to fail. They don't care about that as long as they still get their budget. That's what they want. So I don't know. How do you reconcile that?
I don't disagree. I actually agree with you. But I was listening to a very interesting conversation with Russell Napier. For those who don't know who he is, I highly recommend you to go check that guy out. He's amazing. He's like a financial and monetary historian. He knows a lot about what governments have done in the past. And they were discussing the gold confiscation in the 1930s by FDR and why they did that, right? So they confiscated all these assets and then they devalued gold famously. And he's saying, I don't think that, and so this is called, what is it that they called it, like, they call this capital control, something along those lines. Or nationalization, what are the chances the governments actually take your wealth? And he made a very interesting point. He said back then, let's call it 80% of financial assets were owned by individuals. Nowadays, 90% of financial assets are owned by companies and they hold them for their clients. So governments don't really have to come to your house and take your stuff to take your stuff. They can just regulate your stuff away. They can just tell the citizens of the world, the BlackRocks of the world, you need to sell your stock and buy our bonds. And since they hold people's stocks in their books, they can just do this with the swipe of a pen or the stroke of a pen. So they don't actually, yes, the tactic is going to probably involve going after private assets, people's assets, in order to bail them out. But the way the system is structured today, they can just do it through regulations. They can make it mandatory for these banks to buy bonds. And and what he was pointing out is this has happened before. It happened during World War II. Now, it happens in different ways in different countries. The countries that were actively engaged in the war, Germany, the UK, France, these countries force people to buy their debt. In the US, they talked about it, but they never got so far. They just did regular propaganda, and they appealed to people's sense of patriotism, and people willingly purchased war bonds. They lost a crap ton of money on those war bonds. Those war bonds had a yield that was far below inflation, and it didn't matter. So people got screwed on those bonds. They were forced to buy them, but they never got to the point where they were actually not given the choice. You always had a choice, but I can look them up later. But I encourage people to check out a note written by Arthur Hayes. I don't remember which one it was. It talks about this financial repression and capital controls. And he had some conversations from high-level government officials in the US saying, hey, what if this is not enough? What if just appealing to people's patriotism is not enough to buy our debt? Oh, let's just force them to do it in that case. Mm-hmm. So first they ask nicely, and if you say no, they force you to do it. But I don't think we're going to get so to the point where they just break into your house and take your stuff, because they don't have to, quite frankly. They don't have to do it. They can just regulate that's most of the stuff.
I completely agree with you. Yeah, and the way I thought they would do it is exactly the way you're saying. But I think that the pension funds are the big,
yes.
That's just stupid amounts of money in these pension funds. And all they have to do is say, okay, for the good of the nation, for the good of the markets, so with the stroke of an executive order, by tomorrow, all pension funds must be 40% bonds, 50% bonds, 60% bonds, you name it. It's done with an executive order. It's done in 2 seconds. And then, of course, the value of those, well, they have to sell everything else. So the markets get screwed, all private wealth gets destroyed. The government's propped up for another period of time, days, weeks, months, don't know. And but then those bonds collapse too. And then they've taken everything from everyone.
The thing is, though, this is highly inflationary. So the question that I haven't, and I don't think any of us has the answer, is how does crypto perform in this environment? How does gold perform in this environment? I tend to believe that they're going to go up, they're going to go higher, because this is a highly inflationary thing we're talking about. Financial repression means you have high inflation and interest rates are kept below the inflation level. It's negative interest rates. And the reason for that is because that's how they want to get rid of the debt, through inflation. They want to inflate their debts away. How do you do that? Well, you need to keep interest rates below the inflation level. You need negative rates. How do you do that? Because no free market is going to price bonds at a negative rate. The only way you do it is through regulation, but it's by forcing people to do it. Now, we were there before we had these inflation numbers, right? Rates were zero or outright negative in many places. Now it's a bit of a different situation. Central banks say they're going to fight inflation. Listen, for all I know, maybe they will, maybe they'll try. What I do know, however, is governments are not going to stop. They will not stop. They are not going to say, okay, yeah, we'll pay 10%, because honestly, they go bankrupt. If you do the math, and I wish I knew the math, some people can just spell out and it's beautiful. Suffice to say, at 5% real interest rates, the US government goes to default by 2025. So they're not going to go there. They know this. So the Fed won't cooperate. They'll find someone else who will. And it may well be pension funds, banks, asset managers, you name it. They're just going to find a buyer for their debt. And this is highly inflationary, because at the end of the day, the reason to have so much inflation is governments keep borrowing and spending like there's no tomorrow. Before there was a central bank, we still had periods of high inflation. They took place during, for example, war, when governments spend far more money than they possibly could afford. And this led to periods of high inflation. Now, the inflation would die out quicker because money was based on some type of metal, physical asset. And there's only, you can only break a coin into so many pieces before you run out. But they changed the metal content, they did all manner of tricks. There was no central bank. They still devalued the currency. And what triggered all this was massive amounts of government spending. These are the real culprits, in my view. The central bankers just enable them. So they are just as much to blame, you could argue. But we're about to see that if central banks want to go the independent way, and I don't think they can stay independent for too long, but if they want to try to do this, you're going to see what you're seeing today in France and in Germany and all across Europe, Europe is practically here already, guaranteeing loans. I mean, what is a loan guarantee? If I force a bank to lend money to a bankrupt company, and I don't want them to go bankrupt because it's not politically expedient, and I'm saying, don't worry, if they don't pay, I'll pay. This is a shadow loan. This does not show up on the government's balance sheet, but this is money printing. Because remember, commercial banks can print money too, just like central banks, except they have certain constraints. But governments can pull on certain levers to force credit into politically favored sectors. And they are openly talking about this. It's all about the green agenda. It's a climate emergency. But there can be all manner of emergencies. This is, by the way, this is what we saw during COVID. PPP. What was that thing stand for? Like
something protection. Anyway, whatever.
That was the government telling banks. Yeah, that was governments telling banks to lend to the private sector, and this led to very high inflation. That wasn't necessarily the Fed. So we're seeing, and we're still seeing. The only place where we're not really seeing that is the U.S. I'll grant you that. I think the U.S. is a bit farther behind the rest of the world with all this. But if you want to know what this looks like, and that's what the dollar is doing so well, because I think there's a lot of capital fleeing to the US. Just they're seeing what's happening in Europe. They're seeing what's happening in Japan. They don't like it. So they're going to the US. Now, the US, if you do the math, kind of has the same problems, but they're on a lag. They're a few years behind, luckily. So for now, yeah, you can think of the dollar in the short term. And by that, I mean 1 or 2 years. It's kind of a relative safe haven because you're not seeing some of these crazy policies being implemented. But you're seeing them in Europe. And the way I see it is, hey, listen, we're all in this boat. The US is the most indebted nation in the world. So if Europe has this problem, the US will have this problem too. It's that simple.
Yeah. So, I mean, I agree with everything you're saying. And what you talked about, how the government's guaranteeing loans is inflation, is money printing. It's on the front end and the back end. So the banks, guaranteeing these loans, banks can go in, they create the money, print the money in order to make the loans. There's on step one. But on step two, when those loans default and the government bails them out, that's going to be a money printing exercise. Exactly. So it is money printing and highly inflationary on both sides. And they can disguise it 50 different ways, but they have one thing and one thing only, which is money printing. And then so you just got to get back to yourself, to that concept. It's like, okay, the only way to protect yourself, let's go to the end game. And this is like the Peter Schiff model. He's like, listen, dollar milkshake theory, maybe, yeah, this, that, and the other. Who cares? I know where the puck is going. I'm just going to skate to where the puck goes. Now, he's been saying that for 20 years, so he's lost a lot of decades, right? But at some point, I think everyone agrees he's going to be right. So, but you get into a whole bunch of interesting things there. It's like, well, yeah, being right in what time frame becomes kind of important. But he's like, just go to where the puck is going, and this is going to be a huge problem. It's going to blow up. But their ability to kick the can down the road is impressive. You know, the 2000 had the dot-com bubble, kick the can down the road. 2008 housing bubble and stock bubble, kick the can down the road. This time, as Mike Maloney says, it's going to be the everything bubble, almost everything bubble. It's going to be, stocks, bonds, real estate, and everything's going to get hurt. My only question is, I just don't know when that aha moment goes on in the people's minds that, oh, my only salvation is to leave the system. Oh, the only way to get out of the system is crypto. When does that happen? And that's just the question that consumes me, because to me, it's just the only question that matters. But let me just jump on here. One other thing, because we talked about confiscation of pensions. We talked about those things. And this has been since the inception of crypto. Like the reason I went all in on crypto in 2012 was for this exact thing. There was no way, desperate governments do desperate things. There is no way to get yourself out of the clutches of that. The men with the guns will get you to do what they want. Unless crypto had something special. It had plausible deniability. In the 30s, IRS agents were in the banks watching you open your deposit box to see if you had gold in there, and we're going to take it from you. You're right. They don't need to do that now. All of our money is in like pension funds and whatever else. If you've done that, I've never put money into pension, never contributed to any of those because I could see this coming for 20 years. I've tried to stay as sovereign as possible because I know they're going to try and yes, with the stroke of a pen, force you to buy shit they don't want. And they'll, with the stroke of a pen, they'll outlaw crypto, and they'll do all those things. I knew all those things from the very start. I knew what I was getting into. But there's just no other solution, as I understand it. You have to have some kind of sovereignty somehow. And when you do, how do you do it? How do you manage it? What are you doing? Is crypto going to be the savior? And is that secret ingredient that crypto has that nothing else has plausible deniability? Do you have crypto? No. It's a phrase in my head, right? Is that the saving grace? Or do we just get fleeced a different way this time around?
I think it is. I think it may also involve fleeing, like physically going to jurisdictions that are not going to try to take the crypto from you. Because at the end of the day, I suppose, yeah, a government agent could, knock on your door, come into your house and force you to give up your secret phrase. But like you said, plausible deniability. That's why I think privacy is so important. That's why if you ask me what my biggest worry with Bitcoin is, I think it's privacy. I think it's the fact that if it's not fully private like Monero is, it may lose its fungibility. So we may have a two-tier system or a multi-tier system where certain coins are deemed worthless and others are trading at a premium because they haven't been touched by terrorists or whatever nonsense governments come up with. So but I don't know if we're ever going to go there. I hope not. I do worry about that. I think privacy to me, it's about the fungibility of money. Because if you want to be like cash, you have to be fungible. Cash is fungible. $10 bill is the same as any other $10 bill, unless you destroy it. But assuming they're in good condition, it doesn't really matter who touched it before because you can't possibly know. I do think it's a saving because it's outside the system. Most assets are held by institutions. About 90% of people's wealth are held by institutions. These things are highly regulated, completely inside the system. Not to mention the fact that most of people's money exists as in government bonds. Most money is a bond, is a government IOU. That is the vast majority of people's wealth sits in either houses or government bonds. And so I think you want to have, again, like this Credit Suisse guy, Sultan Bosnar, I think is his name. So you want to have outside money. Outside money can be commodities, it can be crypto, it can be gold. I tend to favor crypto and gold. I do think that I will concede that, yeah, gold in the ground is probably the safest thing you can possibly imagine because because a lot of people, the criticism that I hear from a lot of people is, what if the power grid goes down? But the power grid goes down, you cannot access your crypto. You're not going to lose it unless it goes down across the entire globe. You're not really going to lose it, but okay, I'll grant you that you can't access it. So to me, you want to have both. The reason you might want to have more crypto than gold, I think to me, it comes down to my age. I'm in my 30s, so I prefer crypto. I think it's also a smaller market. So a smaller amount of money, I'm thinking as a trader here, smaller amount of money is going to make this thing go up a lot more than gold because gold is bigger. It's about 10 times bigger, probably more now because crypto is not so much, it's 20 times bigger. So you want to go to the smaller asset that is also a new technology that potentially is going to revolutionize and change the world. That's where you want to be. Now, the reason I think crypto is a solution, to answer your question, you can hold it in direct custody. It's your crypto. Nobody else has access to it. I mean, the idea, I think most people don't understand is that nobody else in the whole known universe knows your secret phrase. No one other than yourself. So no one can take it from you. I keep hearing that. This is funny. Like I keep hearing some crypto skeptics saying, well, they're just going to take your crypto. How? Sure, if it's sitting at an exchange, I have no problem believing that, yeah, the government may try to shut down the on-ramps and the off-ramps. They may actually seize the crypto that is sitting there through regulation. But if you hold it in direct custody, and to your point, I mean, plausible deniability, how are they going to take it from you? They have to go knocking from door to door, collecting all these secret phrases, taking just small portions of people's wealth. It's not going to happen. It's just not going to happen.
Yeah, and this comes down to, and you mentioned it earlier there, which is the concept of fleeing. I hate that idea because I think it does buzz you sometime. Like I think, yeah, like if the West falls, then and even specifically if America falls, then the whole world just goes into a very, very dark totalitarian place. So the concept of fleeing doesn't really appeal to me. I don't think that's going to solve the problem for many years. But at the just being flexible. So something that I did as a youngster, I went to Cuba. I went to a lot of different failed states, communist states. I went to a lot of them. I found the history of it fascinating. So I went to Cambodia and studied the Khmer Rouge, and I went to Cuba and studied that whole thing. And what I found fascinating in all of those things is that the real economy is actually the black economy, right? Every single place that I went to, Cuba was such a trip. Everyone was like, they work for 40 hours a week for free for the government. They get a shitty apartment, shitty healthcare, and shitty schools for their kids. And that's just a given. You have no money. You're just poor. You have absolutely nothing at that point. And then everyone has a side hustle. And all the guys are working their ass off, side hustling. And pretty much without exception, pretty much all the girls of age who are appropriate, they're basically prostitutes in their spare time. Work for government for free. Girls are prostitutes. Guys are hustling. And this is my reality. It was what I saw in Cuba. And I've always held that in my head with regards to crypto. I'm like, okay, like what's going on here is that the black market is going to be essential because the government planners, desperate governments do desperate things. The rules get bigger and bigger and more onerous. And one day, the only way out, the only thing you can do is everyone is forced to become illegal. Everyone is forced to go on the just to survive because they were like, let's take another example. Let's go to the Ukraine famine, 1930s. It's like, okay, sorry, we need the wheat. We're just going to starve a country to death. That is what they will do. They do it. That's just what they do. It's what governments do. It's so hard for people to think they're going to do it in the West, but that's what they do. It's all they know. And they're going to do it to you. So it's like, man, when you know this up front, it's like, okay, black market's going to be essential if you're lucky. And if you're really unlucky, they just come and take all the food. And now it doesn't matter. Gold, silver, nothing works. Nothing works. And so these are the things that you have to think about. It's been the plan for me for just forever, as terrifying as it is. All right. Let's change the tune a little bit here. Let's think. I would love to talk to you about your timing model before it's go. We've talked about it before. You've given us a little bit of a heads up. Give us a quick intro to it again, and then tell me the status of your signal.
Okay, so first with the intro, not good at that, but I'm going to give it a shot. So the timing model looks at cycles in crypto assets, and I started by noticing there's an 80-day cycle. When I say a cycle, I mean that every 80 days you have two important lows. So you have a low, a high, and then another low roughly 80 days apart. So I discovered that one. This is based on a framework that I've been using for years. And it's just, I think of it as a way of studying markets. I don't know why markets are so cyclical, but they are, and they all are. They all have different cycles. It's a very powerful tool to study price action. So the way it works is every cycle is made up of smaller cycles. And of course, every cycle is made up of larger cycles. So in the case of crypto, the ones that I follow 4 cycles roughly. One is 4 years. That's the one most people know because they say it revolves around Bitcoin's halving. I'm not convinced myself because I'm a cycles analyst and I've seen 4-year cycles in other assets. Gold, I think stocks used to have one. I think it's kind of gone now, but 4-year cycle is there in many financial assets. You break it down into 4 smaller pieces, about 320 days, because it's not really 4 years in Bitcoin, it's a little less. That one gets broken down into 4 80-day cycles. And that one gets broken down into 4 20-day cycles. And I've seen intraday charts that suggest that you can break down the 20 cycle into 4 5-day cycles. That one breaks into 4 1.25-day cycles. And on it goes. It's like a fractal. So I developed this model over the years. It's a combination of many different theories about what makes prices move or how to study price action. It's very powerful in crypto, I have to say, very powerful. So it could be that crypto has been super cyclical around Bitcoin. It's halving, it's bull markets. It's all looked pretty similar to past iterations so far. Now they all have, every cycle has its own nuance to it. But it usually is always the same. So you go fast forward to 2022. I was expecting the bear market to start around December, November of last year. It did on cue. I was expecting the catalyst to be the Fed pivoting, suddenly saying inflation is coming. The reason for I was expecting that to be the catalyst is because I noticed that even though they were saying, we think inflation is transitory, I said many times, look at what they're doing. Why are they sucking money out of the economy? Oh, because they worry about inflation. I said, July, it's not going to be enough if you just do these shadow rate hikes, because they were like hiking rates for the reverse repo. They were doing all these financial alchemy to try and rein in this money. But at the end of the day, what the most powerful tool that central banks have is honestly jawboning, is their mouths just talking, just saying, hey, we really need it this time. That's a real powerful tool. So I was expecting this to be the catalyst for the next bear market. A crypto bear market is made up of bearish 80-day cycles. So it's basically every 80 days you have two consecutive lower lows with a high in between. So if you want to pull up a chart, anybody who's looking at a Bitcoin chart, the bear market started, the highest November 9th. There's an 80-day low on the 23rd of January. The 80-day high following that is the 28th of March, or thereabouts. The next 80-day low was on June 18, and this is where I think things got interesting. Following that June 18 low, we have another 80-day cycle low, roughly 90 days after. It doesn't have to last exactly 80 days, by the way. It's actually 80 days plus minus 40, so there's a lot of variation to these. It's just averaged down to 80. The next low was September 21. Now, September 21 is a double bottom to June 18. Right? It didn't make new lows. So it started making new lows. You go back to November, it was making new lows. The January 23 low is lower than the previous low, which is in September of 21, September 26, 2021. So the January 23 low, that's lower than the June 18 low, that's lower. But now we have one, September 21, that's slightly higher than the low from June 18. So we have a full, what is known as a neutral cycle. Neutral cycle means it starts, it goes into a high, and it makes a low that's roughly the same price as the previous. Now, in the past, after we've seen a bear market like we've seen in 2022, once you see that neutral cycle, that double bottom, that's it. That's the end of the bear market. In the past, this has always been the case. Now, in the past, I've also seen periods where you have big crash, a bunch of sideways cycles, another crash, and then you have the sideways, the neutral cycle that confirms the low. So that's why you want to look at timing. 2018, for example, Bitcoin goes from a high in December to a low in February. Then it makes a bunch of neutral cycles. August, I think August is one, April 26, I think was one of the 80-day cycles. These are all at the same level, around 6,000. Breaks down in late November, makes a low. So you want to look at timing. If I have a neutral, if the bear market starts in December and by April you're making neutral cycles, that does not mean the bear market is over, because you need to give it about a year, right? About a year. It doesn't have to be exactly 1 year. But we've had enough duration now. So from a timing perspective, I'm looking for the low to be around. I was looking for the low to be around this price, these prices. And I was waiting for confirmation in terms of price action. I was waiting for the model to say, yeah, September 21 is an 80-day cycle low. And hey, it is a retest of the June 18 low. We have a double bottom. The only thing the model was waiting for was confirmation of that September 21 low. Confirmation meant that you just needed prices to stay above that price for a while. On October 26 and 25, those 2 days, Bitcoin broke out of the key levels that the model had as to confirm that a low had taken place in September 21. And so right now the view is this is a neutral market. It's not bullish. It's a neutral market. And the implications are that I believe that 17,000, 18,000 will be retested again, probably before the end of the year, but it's going to hold. It's going to hold, and it's going to, in time, be confirmed as the bear market low. Now, to confirm that a next bull market is starting, Bitcoin would actually need to make a higher high in this cycle, meaning it needs to break 25,000. I don't see that happening anytime soon because, yeah, we flushed out all the sellers, but it's the world is still pretty negative out there. Most people are bearish. There's really no catalyst. I don't buy that you need the Fed to pivot in order for risk assets to rally, because I think that the inflation story has not changed. But these things go to cycles in and of themselves. So the cycle now, the narrative now is, well, the Fed is not going to pivot, so it's the end of the world. As long as that's the view that most people hold, they're not going to buy crypto. They're not going to buy risk assets. And crypto is seen as a risk asset. So the narrative has to shift. Now, it could be, Treasury buybacks. It could be Europe blowing up. Maybe it blows up so hard that it forces the ECB to pivot as well. But for now, my view is neutral, because that kind of what the past bear markets would suggest. The last time we made a December 15 of 2018 was the last bear market low. The breakout to new, that kind of told us, okay, we're starting a new bull market. That took place on April 4th. So it took months, literally. So we've recently had confirmation that the bear market low is in, but there's not much in the way of suggesting prices are ready to rocket higher. I don't think that's going to happen. I think the sideways trend will continue for a while. I think that's a good thing.
So let me say that back to you, see if I've heard you correct. Your timing marker has triggered to signal the end of the bear market, but it is not triggered to say the start of the bull market. So you're predicting a neutral sideways trend in the range. I'm going to get here at 70,000 to 25,000 for the next several months.
Yeah, that's pretty much the view.
Okay, perfect. And that kind of narrowing range, or even a stable range, you didn't say it was narrowing, you said it was stable. Does your model indicate at some point it'll break out either up or down? Does your model indicate which direction it will go?
Yes, it should be higher. The view is it does not exceed 17,000 and a half, I think. And by the way, it can exceed it on an intraday basis. It can even stay below 17,000 a couple of days max, but then it goes back up. So the view is that this is the range we're in now. And to answer your question, it would be contracting volatility range. So it wouldn't even test 25,000. I think there's a very good chance that it tests 18, 17 again. 25 is off the table in my view. It's not going to go there because it should be on declining volatility. And if people want to bring up a chart of Bitcoin, this is basically 2015. This is exactly what happened between January of 2015 and August of 2015. If you want to look at that time period, that's kind of what the model is suggesting now. We had a brutal, fierce sell-off, bottom that's confirmed. The first cycle, the 80-day cycle that confirmed that low looks a lot like the first cycle of the 2015 period. So it's looking a lot like that. And interestingly enough, the bull market looked a lot like the bull market of 2012 through 2013 too. So it's very similar. There's not that many examples to use, but this last bull market did not look like the 17 bull market. It looked more like the 14 bull market with a big crash in April and then another higher high, which was way higher in 2013. This time it wasn't so much higher, but that was the framework that I was using. Ethereum looked a lot like actually it didn't exist back then. Ethereum looked more in 17 like it did in 21, but Bitcoin did not. Bitcoin basically had no pullbacks in 2017. It was best bull market ever. Basically, it had no major pullbacks in 2017. It was just higher. It had obviously went down 30% on the China ban news, something like that, but we had nothing that looked like the correction from May to July of 2021. That was pretty fierce.
Yeah.
And did we see that before? Yeah, in 2013. Did the same thing. I always like to look for analogs. So if you're looking for example, the stock market, just to throw some free stuff for people out there. Stock market, just bring up a chart of 2008 and a chart of the S&P now. They look practically the same. It's scary even what the implications would be. And Bitcoin looks a lot like 2015.
Okay, and that 2015 period, so that cycle between the 2013 top December 29, let's say the 2016, that was this perfect kind of parabola shape. It turned into a cup and handle that led to the explosive rise in 2017. Are you thinking that cup and handle kind of, or that parabola shaped bottom, is that where your mind's at?
Yeah, I call them rounded bottoms.
Rounded bottoms.
U-turns. That's what I'm working with.
Okay, awesome. Juan, thank you so much for joining us, guys. Thanks so much for joining us, and we'll see you soon. Take care. If you like my chat with Juan, you'll absolutely love my interview with Dr. Jeff Ross, where he gives you specific instructions for taking advantage of the market right now. Go ahead and click this link right here.